Hi everyone, thanks for joining us today. I'm Maryam Akram, I'm a research principal at Chartis Research, and I'm joined today by Schoutens, professor at the University of Leuven, and Erik, Vynckier, board member and chair of the investment committee, Foresters Friendly Society. Today we're going to be talking about cyber and black swan events and modelling specialised risks. So black swan events can broadly be defined as unexpected and improbable events that have widespread impacts. There's a tendency to rationalise and explain these events in hindsight. However, today we are going to explore the extent institutions can prepare for these events, including approaches to modelling their risks. Okay, so to start off, it would be good to hear from both of your perspectives. What are some recent high-profile events that could be considered black swan events? And are you seeing any shifts in attitudes by regulators and institutions towards these kinds of events?
Right. Shall I start? Erik Vynckier, hi.
Sure.
Yeah, you can hear my voice clearly? Okay, good.
Yes.
Well, I mean, two recent actual event, black swan events, if you wish. At least I have the impression that most were not prepared and most did not forecast anything like this is COVID and the lockdown. That's number one. And number two, maybe some strategic advisors saw it coming, but of course the war between Ukraine and Russia, and they were, I guess, for the financial sector, maybe not for certain other people in other professions, but for the financial sector, there were certainly sort of black swan events, because for all I know, nobody had prepared for this. If you look at COVID, I think you can actually decompose that black swan event probably into two separate events. One is this virus itself, and two is the rather unprepared and inept response that we gave to it with the lockdown. Of course, if you lock down an economy, you create all sorts of supply shocks, almost. Yeah, by design you do that. It led on to another burst of quantitative easing and extreme low interest rates, although they were already too low to begin with. They led to very expansive government budgets and deep deficits, and then of course they led almost immediately to an inflation peak that most people had not predicted. I mean, I had predicted inflation as a consequence of these measures, but I was one of the few, and I was poo-pooed when I first came up with that idea. Then the Russian-Ukrainian war, I would say, was also maybe less a black swan event, because of course, the difficulties were clear since 2014. But at least insofar as financial practitioners are concerned, this was not on our monitor, and then of course it led to additional issues in supply chains, including oil and gas, including fertilizer and so forth, which have certainly throttled the European economy, to a lesser extent the US. But yeah, we were not prepared for that, certainly in the financial sector. Were regulators prepared for that? I don't think so. They were at most, interested in extreme events and black swan events from a theoretical point of view, but these particular ones were certainly not something that they raised with anybody. The response was, of course, the excessive quantitative easing with now, presumably, I presume that the sector considers this the least worst outcome, the inflation issues that we've had since were sort of, it was either, do we let institutions go bankrupt, do we let economies go bankrupt, or do we just say, okay, we'll do quantitative easing, we'll do guaranteed programs for different sectors and firms in the economy, and we'll take whatever comes out of that. That will be a negative outcome, but it's better than letting the economy go burst. I think that was largely rather the central banks and the ministries of finance and governments that made that decision than the regulators per se. Would be my opening statement. So there you certainly have to black swan events that nobody in the financial sector had thought about. Wim?
Yeah, thank you, Erik. Actually, I agree with you with the identification of these events as being events with an immense impact for society and also the financial market to some extent. And you already hinted about that. I know you know this. Technically speaking, one should not use the name here Black Swan because actually the pandemic is already described in kind of Nassim Taleb's book, which introduces the term Black Swan as something that could happen with huge impact. And as you already correctly noted, the Russian-Ukrainian war is not 100% new. It was already ongoing, the conflict. And actually, so part of all the mess and all the consequences and all that it brings is to some extent not coming to a surprise, but we more or less make the decisions that led to this kind of high impact events. And so technically, some would say it's not a black swan, it's rather a white swan. It's something of high impact, but we at least know that it is there. And so I want to clear this out for the rest of the conversation that we actually will talk, I guess, about really the high impact events and the consequences there for financial markets and insurance companies and the society in general. That being said, yes, and you're very right in saying that this is probably one of the key reasons that inflation kicked in and that interest rates now have to go higher, and that has all the consequences. So if you could speak about collateral damage on the financial markets, the impact is really huge. Quantitative easing brought inflation, inflation brought higher interest rates means that a lot of the long-term bonds which were issued at zero coupon by lots of governments on even 50 years, some even 100 years, went completely down. One was thinking that the bond market was not volatile. Now we see that could be extremely volatile, that kind of AAA bonds could go from 100 to 50. And so the impact is huge. And we all created that to some extent ourselves. If we talk about really a black swan, then you can wonder, can we model that? Probably not, because we don't even know what we are modeling. But so let's focus on the extreme events with high impact. And I agree that these are the two that really governed the markets the last, say, a couple of years. And many of the other things that are sometimes mentioned as high impact are basically finding their origin in these two. So I agree with that analysis and having cleared out that black swan is actually something that we, as a term, that we don't have to take too strict in further discussion.
Mm-hmm. Okay.
Okay, yeah, well, I want to pick up on something that Erik mentioned, and that's the regulatory aspect. So I guess what challenges and issues do you think arise from attempts to incorporate black swan events or extreme impact events into regulation and capital rules? And, to what extent do these standardized models work? Is preparing for these black swan events or high impact extreme events using standardized models in itself contradictory? Erik, if you want to get started, and then we can.
Well, I mean, Solvency II requires that we look at our balance sheet and that we identify all of the quantitative risks that have a quantitative impact on our balance sheet, and we do that as a 1 in 200 event, 1 in 200 years. And it uses value at risk. There's two things to say about that. First off, value at risk is not a coherent risk measure. People with mathematical education and risk management will understand what I mean by that. But let's think of a Monte Carlo. When you have 10,000 scenarios, then there may be two scenarios very close to the 1 in 200, right? Or maybe even 10 scenarios. They will all be very different scenarios. So it's not it's not the sensitivities that you compute and so forth will be just purely chance sensitivities. dependent on the seed number and whatever, because it might be a high rate scenario that kind of is in your Monte Carlo, that is the 1 in 200. But switch the seed number and it might be an equity scenario that becomes a 1 in 200, right? Because it's not coherent. So that has been known for a while. I think ETH in Zurich, the Polytechnic School in Zurich, has long since established that coherence is a necessary aspect, is a necessary feature for a good risk measure, and has developed TailVar, which is sort of the average scenario of every scenario that exceeds the 1 in 200. Of course, it's a bit even worse, but you could kind of say, well, let's do 1 in 190, and then the average will be sort of the same. And this TailVar is coherent. And so it seems that the problem is solved, but in fact it isn't, because as these people in Zurich and people elsewhere have equally come to the conclusion, this essentially cannot be calibrated. There is no way of telling. There is no way of telling what a stable distribution would be that has stable fat tails. Which one would fit? Which theoretical mathematical formula would fit? And how do you even calibrate it? That's essentially that's not feasible. What the EIOPA has done for us, and so we kind of go with the mistakes that the EIOPA has done, because the EIOPA is sort of the regulator of regulators with their responsibility. They've calibrated some long-standing time series, which you may just about have for the equity markets, the S&P 500 and so forth, started in the 1950s, or the Dow Jones started earlier. It's not a good index at all. But for credit, you already start to struggle. For interest rates, you struggle even more. The euro is not even 200 years old. So how could you kind of say, we have a 1 in 200 event for the euro interest rates? We don't have that. And the question is, even if you go 200 years back for some time series that you would have, is that relevant? Because the economy has changed fundamentally. So essentially, these 1 in 200 stress tests that we have to do, they cannot be based on strong mathematics, and they cannot be based on strong enough databases. So the question here is, are we just fooling ourselves? And I suppose to some extent we are. That's the reason that regulators themselves build a lot of requirements around the actual capital model that you use, because they know that they need to make decisions, essentially, and those will be to some extent arbitrary decisions, but they want to have the entire pool of companies that they are responsible for. They want to put them on a consistent basis, one company between the other. To give you just, I suppose that they achieve, although we're kind of foolish to think that's a 1 in 200, and it's a bit of a waste of time to kind of try and establish 1 in 200 scenarios for, say, new asset classes and so forth. I'm often asked what's a 1 in 200 for private equity, or what's a 1 in 200 for private debt and so forth. Nobody is served by doing that search. You're better served by spending your time on actually, identifying your actual risks, investigating, monitoring the covenants and so forth. It's far more useful. It's far more. To give you just one small example, the sort of consequential crash that we had in September in the UK in pound sterling, in the gilt market and the sterling swap market, in just a few days broke through everyone's estimate of what a 1 in 200 in sterling interest rates was. So it just happened in a few days. In the past, in the global financial crisis, there was one hedge fund, macro hedge fund of Goldman Sachs, managed by Goldman Sachs Asset Management, that broke probably the 1 in 200 estimate that they have 3, 4, 5 days in a row, right? So I think that unfortunately all of this is embedded in regulations, in legal texts, and it's also embedded between the ears of people, that we manage capital against the 1 in 200 event, whereas that's not practical and not feasible at all. So probably there needs to be a rethink there. That will take forever, that rethink. Because of course, if once it is in directives, once it is in legislation, try and get rid of it. But that's where we are.
Yes, I agree on many aspects again. And just let me add that indeed, if you started your kind of answer with mentioning the VAR. We all know that the VAR has been has critiqued as being kind of only one quantile, and one quantile doesn't tell you anything of the tail. Then actually a regulation went into what you call CVAR, or others are calling it expected shortfall. Basically, it's an attempt to take indeed the whole tail in perspective. But what one does is taking all the tail kind of to one side of that quantile, the risk part of the tail, but treat every event on that tail equally. So it's an expected shortfall. If you give away to each kind of tail event, as you were saying, you're 1 in 200 and you're 1 in 99, or that kind of thing, you take the average of it. Also, that can be questioned. Why that the 95 quantile is equally important as the 99 quantile, as it's equally important as the 99 point something quantile. So also there are some theoretical movements and so on, moving beyond also expected shortfall, and that's basically then also where I have been active, but especially also inspired by the people in Zurich and the ETH. What we then call conic finance. And conic finance and this risk kind of new vision on risk is basically also giving you a theoretical platform to take all these kind of risks that are there, also to look at it in a very prudent way. In the sense kind of, there is not enough data. You mentioned that is clear. We have not enough data. We are measuring things in the tail where sometimes we don't even have one observation about. So there is clear measurement risk. We don't know even what we are measuring. But also the models that we put forward there, is it a distribution with fat tails? Is it something else? Well, it is a distribution. It's something, it's a mathematical animal, and we need to calibrate it. And so we have model risk, not knowing what the right model is, and we have calibration risk in how fitting that model on whatever data is. And so even in the estimation of it, there is a huge uncertainty. And it's good that we mention and that we are aware of that. And sometimes what bothered me on the regulation, because that was the key point here, is that we believe if there is regulation in place that it's all solved. And that we have done our best and that we don't have to care anymore. I think it's just the other way around. That, okay, we do one attempt, but knowing what we know is that there is so much uncertainty on every aspect that this is clearly not something that is then, we tick the box is dealt with. And so I'm afraid that sometimes regulation is more to give us a kind of good feeling that we did our best and we can blame somebody else and we can blame the regulator or whoever we can blame, but at least we don't have to blame ourselves. So the real risk management is then in really trying to see what's getting, what is leading us to these extreme events, and some are really completely sudden. I think if a volcano erupts, okay, there is maybe a few days, and if there is some other stuff, you can't really expect that. But in the sense of the things that were mentioned in the beginning of this session, the pandemic and the Russian war, actually to some extent we created that ourselves. It is a consequence of political decisions, and hence there we should do a kind of an individual risk management and seeing what all the consequences are. And I have a feeling that this is not done in either way enough. And maybe later in this session we will come to what could be probably other events that are on the horizon that we have to think about. And there I also have the feeling that, okay, this is really what we need to do. We have to start thinking about what is not the immediate consequences, but also the next and the whole collateral damage there, because it are devastating systems. I want to finish with one thing here, because we are talking a little bit about the models now. It always strikes me that in extreme value theory, where we trying to estimate these extreme events, we are using extreme value distributions. And the most known distribution is the stable or the alpha stable distribution, but you have more of these distributions. And they are really fitted or suited to have this kind of heavy tails in it. Now, if you calculate, let's say, the variance of such a distribution, or the standard deviation of such a distribution, it often does not even exist. The tail is so flat that standard deviation not only exists. Now, fine, this is good. But on the other hand, if you look to financial markets, and let's look to the S&P, and we look to the standard deviation of the S&P, it clearly exists, because we are dealing with an S&P market where there are volatility swaps all over the place. It's a huge market, the variance swaps and the volatility swaps and all the option contracts. One is trading daily in billions of volatility swaps. One is trading volatility, one is trading standard deviation. So on one hand, we have a market, a financial markets trading in billions of standard deviation, whereas the models we are saying has kind of distributions that don't even have a standard deviation. So it's a little bit a contrast between the real world, what is happening like in 99.9% of the day, and then the exceptional case. And the question is, can we put them all together in one kind of big model? And I think that is not really feasible, seeing all the risks that I mentioned before, like model risk, calibration risk, measurement risk, and so on. And I think I'm done with my answer now. So go ahead.
No, I think you both touched on it slightly in your responses just then. But I think, if forecasting these kind of events is fundamentally unreliable, what can businesses do to prepare? And I guess if we think beyond compliance, as that might, as you both mentioned, given us false sense of security.
There's a couple of things that we do which are part of risk and compliance management, but that are not per se capital computation or capital management. One thing that is sort of an annual requirement for insurers is the own risk and solvency assessment, which is a process more than just a computation. Right, just a provision of capital. It's a process that looks at your business, analyzes the risk factors in your business, analyzes the scenarios that might harm your business, and you think through what the quantitative and qualitative consequences are for that. Are you prepared for it? So the own risk and solvency assessment, the ORSA for short. The second thing that is now running, which is more a program, which is the operational resilience. Stress is more than stress test, right? It's a real program, operational resilience requirement that we discuss both with the FCA, the Conduct Authority, which is for consumer protection, and the Prudential Regulatory Authority, the Department of the Bank of England, which is prudential supervision for stability of firms and the markets. So essentially, what we do in the operational resilience tasks is that we figure out which sort of things might harm us, and this might be, it might be like an interruption of IT provision. What do we do? An interruption of, say, payment services happening. We of course use the payment services of the banks as an insurer. We pay our clients, we collect our premiums through the banks. What would that mean for us? How would that harm us? And so rather than saying we should put this or that amount of capital against it, the question is what would be risk mitigation against it? And if we cannot fully eliminate the risk, how would we react to it? How would we prepare to it? So who will do what. To some extent, it might just be in that case, this department needs to do this extra work, which is something they don't have to do under routine circumstances, but under such circumstances they will have to do this additional work. So you kind of stress test the processes and the operational side of your company, whether it can handle unexpected things or things that are not supposed to happen, but that might happen. Alongside that, we also have two different initiatives in the industry. One is called ORIC, and the other one is called ORIX. ORIC, the Operational Risk Consortium, was mostly set up by insurers, and then of course the banks set up ORIX, ORX, which is the same thing, but it has is more set up by banks. I mean, today people kind of flip across the two platforms, but they are platforms where you can collect your past operational risk events, and you can explain them. And they are stored in those databases, and they are accessible to other companies that agree to submit their operational cock-ups. And so you can check in an anonymized fashion what has happened elsewhere in return for telling other people that, in the past we've had events here and there. And so it gives you a much broader pool of things to look at. It probably from time to time gives you something that you hadn't thought of, because it happened somewhere else, and so that's incredibly useful. There are some things you can do in terms of reinsurance. For instance, there is cyber reinsurance. It is available. It is often with a threshold, so a minimum that you pay yourself. So if you kind of are not careful, you will at least pay your own. You will at least share in the damage yourself, which is an incentivization. And they are often also capped at, significant sums. I suppose the reinsurers themselves struggle with having limited historical experience in this sort of event. Of course, there is a bit of historical experience, and they have their own expertise, which analyzes companies, which analyzes the processes that we use, which analyze the hardware that we have, which analyze the software that we have, and so they can base that underwriting on something, but they still come the maximum payout, which makes it surprisingly insurable, and frankly fairly affordable. I'm surprised that these events are open for reinsurance at an affordable price. I'm a little bit surprised by that, but okay. So these are the sort of things that we do. We try to kind of understand our risks, mitigate our risks, and make sure that the downside is sufficiently capped, if necessary, through the insurer. But then, of course, it's the reinsurer's problem to get that underwriting in place and so forth.
For sure. Okay, so we have a couple of minutes left, and I think in the spirit of considering your risks and operational responses, I think both of you, if you could very quickly, Wim, if you want to start, what are some underestimated risks, and what do you think institutions should be making sure they consider?
Okay,
Wim first. Go, Wim.
Okay. Here are two risks that I think really are underestimated, and that is one, solar flares. If a burst of the sun, magnetical particles, is hitting the Earth, it will have devastating kind of consequences on everything that is electric. So if you see in the electrification that we're moving in, especially in the West, electrical vehicles, electrical everything, this is an immense risk, because even if you can see it coming, it will lead to blackouts in the whole kind of region for at least 48 hours, and probably if some transistors are hit, it will have an immense impact. And this is an event that is estimated under models which are models and absolutely not clear how accurate they are, but at least it's a 1 in 150, 1 in the 200 events, as you mentioned. And the last event of that magnitude happened about 150 years ago. It was the Carlington event in 1859 or something. And so we can, then the effect was not that immense, because there was not so much electrification. Now it would have is huge. And second thing I want to throw in, and I will be brief on that, is the whole sustainability religion that is building and all measures that we are taking there. I'm in favor of changing our way of living, how we live with each other and the planet and the environment, but with putting all kind of efforts on certain inferior solutions that are sustainable in contrast to others could lead to an immense systemic risk for lots of the industries and the West, and we are not prepared there of the consequences, and especially if these things are written in the legislation, it is creating a systemic risk in one corner of sustainable energies and so on. And if something is wrong there, or it doesn't function, and we put all kinds of our money on these solutions while the rest of the planet is maybe not doing that, it could be having a huge effect on the Western financial markets. And I'll stop here.
Okay, thank you, Wim. Eric, if you just really quickly want to mention yours.
If I look at the catastrophe risk, I against the narrative which is in the public domain, it is not the adverse weather events, but it's the earthquakes. The earthquakes are far bigger events than, you know, a hurricane hitting North America or something. Earthquakes are far heavier, far more damaging in terms of cost of life, economical damage, and so forth, and they are very much underinsured. In fact, I mean, it's everybody for themselves. Earthquakes are not well insured. And they are by far the biggest, catastrophic events for economy, but also, you know, for just sheer number of lives. I do think the negative productivity shocks that will be triggered by our approach to the energy transition are badly underestimated. So, the cost of this and the practicality of this is really not understood, and it's we're sort of living in la la land still. I think that will lead to significant inflation and significant losses of wealth here in the West in particular.
Okay, thank you, Erik, on that.
Well, okay. Well, we're out of time. Thank you so much, both of you. And if anyone has any questions, just reach out, and we'll happily direct them to
thank you,
our
Maryam.
speakers. Thank you. Okay, and now we are going to introduce our Insurance Analytics 25 ranking. We'll be publishing them very soon, so excited to share them with you all.